All right, so we'll go ahead and get this kicked off. Good afternoon, everyone, and welcome to our June webinar, Exploring Energy, Powering the Future. If you haven't joined us before, we do these once a month, and one of our PMs will come on and provide an update on just, what's moving the markets, what are we watching, and, how we are positioning our portfolios in response. I'm Jacob Ford. I'm an investment specialist here at Tortoise. And today I've got the pleasure of being joined by Senior Portfolio Manager Matt Salee. Matt, May brought a lot of meaningful developments across the energy landscape. The conflict with Iran is now over 100 days old, yet we do not have a clear resolution in sight. The U.S. continues to export records amounts across both the oil and natural gas markets. And then, we've seen a lot of very active capital markets. And it's not just the high profile names like SpaceX and Anthropic, but we've also seen some movement in the energy infrastructure space as well. So glad you're on to talk with us about this. And, it should be a good conversation. And just before we get started, a quick reminder, we will do a Q&A at the end of the session. So feel free to submit questions at any time to the Q&A box on your screen. You do not have to wait until the end. And for those of you who don't know Tortoise, just kind of a quick overview. We are energy specialists. We've been around since 2002, focusing on the energy sector. Today, we manage a little bit more than $11 billion in assets. Across the firm, we bring more than 100 years of combined energy sector experience with an expertise that spans the full energy value chain from the wellhead to the wall socket. So with that as a backdrop, let's quickly look at see how our investment capabilities are organized across the energy landscape. So you see here we've got four kind of main sleeves where we invest in energy. We've got approximately $8.5 billion in the energy infrastructure sleeve. This remains the core of our heritage and expertise. Next, we've got about $1.6 billion in electrification infrastructure. This is positioned for the long-term growth as AI, data centers, and grid modernization continue to drive power demand. Third, around $600 million is allocated across the broad energy strategies, providing exposure to the full energy value chain. And then finally, we have about $200 million in energy adjacent strategies, which are designed to target companies that are going to benefit from or help support the broader energy system. How are you going to access these? Well, we've got a few different strategies. 7 ETFs, both active and passive. We've also got a mutual fund, Tortoise, and a closed-end fund, and two separately managed accounts. But before we get into the polls, just a couple of announcements we're very excited by. One of these energy adjacent strategies is our AI infrastructure fund. Ticker is TCAI. We launched this August of last year with just about $500,000 in seed capital. And today, just barely 9 months later, we're up over $230 million in AUM. So very, very impressive growth in terms of flows. So really, really impressive way that the market has latched onto this fund. Secondly, the aforementioned mutual fund Tortoise on June 2nd celebrated its 15th birthday. So I think it just goes a lot to show how investors have really, been drawn to Tortoise and our energy strategies and looking for our expertise with just how long that fund has been around and how well it's done. And then lastly, we're very proud of our various insights. We like to think of ourselves as the energy experts. So I'd encourage you to go to our website under the Insights and Education section and check out our guide to the energy markets. We publish these each quarter, and essentially it's going to be, it's a very graphic heavy. What are the topics in energy that you and your clients probably want to learn about? Some of the slides, are going to be, you'll see the same things each quarter updated, like what kind of exports, just numbers like that, and then also just other timely topics. So, we're very proud of that guide to energy markets. So go ahead and check that out. Now, before we turn this over to Matt, we want to get a quick sense of what is on top of mind for everyone as you think about energy markets and as you're having your client conversations. So we're going to go ahead and launch a quick poll. Just two questions. first question is, what do you see as the biggest driver of energy markets for the rest of 2026? Geopolitical risk in the war in Iran, US oil and LNG exports, AI and data center power demands, or commodity price volatility? All right, looks like we've got the answers coming in.
I'd be
And the
pretty
overwhelming
precise.
was geopolitical risk and the war with Iran at 71%. And then coming in second, AI and data power center demand. Matt, no surprises there at all.
I was going to say I'd be pretty surprised if that first one wasn't the winner.
All right, we'll go on to the second question. What are you seeing? Where are you seeing the most client interest today within the energy investing? Traditional energy exposure, midstream or energy infrastructure, utilities, electrification and nuclear, or AI infrastructure and power demand? All right, we got a little bit more of a spread here. About a quarter of the folks thought midstream and energy infrastructure, utilities, electrification, nuclear, and again, no surprise here. The overwhelming winner was AI infrastructure and power demand, about two-thirds. So Matt, based on the responses, it looks like we've got a good group here today. They're engaged with the key themes shaping the market. I think it should make for a good discussion. I expect we'll have some thoughtful questions at the end of your remarks. And again, as Matt's walking through the market update, keep those questions coming through the Q&A box. We'll collect them throughout the session and get to them at the very end. But before we yeah, so with that, Matt, I think we've got everything going here. So let's walk through what you're going to cover today. First off, we're
Sounds
going to
good.
hit energy performance. Next, we're going to look at industry activity, including those oil and nat gas exports. Third is our featured topic of the month, which is capital markets activity. And last, we're talking about portfolio positioning. So with that, Matt, I'll go ahead and turn it over to you to start with performance.
Yeah. So thanks, Jake. Nice job there. For the quarter, I tell you, technology you see on the top there had just an absolute ripping quarter, along with communication services, which in my mind's a little surprising, kind of given all the uncertainty going on from a macro standpoint. Um, Similarly, if you look at the bottom of the chart, with a lot of the noise going on and commodity price volatility, I would have expected energy to perform better so far this quarter. That hasn't been the case, but some of that may be just a strong start to the year. Utilities have also struggled so far this quarter, which to me makes sense given the 10-year is up, I think, about 25 basis points so far for the quarter. So that part does make sense. And then if we want to go to the next slide, I can dig deeper into what's going on within energy and the various subsegments. Similar to technology, clean energy is kind of a technology analog, tends to have a bit of a correlation. So not terribly surprising to see that performing well for the quarter. Um, and then similarly on nuclear has also had a decent quarter. And then on the bottom, oil prices have given back a little bit and natural gas prices are down. So in line with that, the producers are bringing up the bottom end of the pack for the quarter. A lot of that is Exxon and Chevron that are big weights in the energy index and have not performed terribly well so for the quarter, although still quite well for the year. And then speaking of the year, if we want to flip forward, I can cover S&P sectors for the year. Despite a softer quarter, we still look quite strong for the year, and so that was really just very strong first quarter performance. What's interesting is technology started out the year very soft in the first quarter, one of the bottom performers, and obviously very strong second quarter thus far performance has brought it to second in the pack. Energy infrastructure also performing pretty well, up north of 20%. And then, of course, as I mentioned before, utilities still positive, but somewhat subdued for the year, just with rate pressure. And then within energy year to date, we want to flip forward. Um, Oil's up, north of 50%. Frankly, I'm a little surprised that it's not up more given the level of disruption going on, but nonetheless, it's still up pretty significantly for the year. Refiners have also performed very well for the year. I would just mention all the equity segments are positive for the year, but refiners lead the pack for the equities. That's a function of refining margins continue to be very strong, free cash flow generation also quite strong. And early in the year, uh, the Venezuelan barrels that have hit the market that are heavy crude have widened out the discount, and that's a big beneficiary, very beneficial, I should say, to U.S. and particular Gulf Coast refiners. So you see that in their performance. Clean energy, as I mentioned, is strong. On the bottom, interestingly, natural gas is actually down for the year. We're the one part of the world where natural gas prices are not up significantly. If you live in Europe, your prices are up about 90%. If you live in Asia, they're up about 130%. So while energy prices overall are high in the U.S. following the breakout of the war, we are relative winners given that our gas prices are actually down and our oil prices and product prices are up quite a bit less than the rest of the world. So um, that covers performance for so far for the quarter and for the year. And then I could jump into some of the topics in terms of what's going on, sticking with kind of what's going on uh, with energy in the U.S. And the punchline there is we're exporting a ton. So uh, our slide here shows 5.6 million barrels. That's just oil. We're also exporting a similar amount of product. When you add the two together, we're exporting a little bit, basically in recent weeks, between 13 and 14 million barrels on a daily basis. So a massive amount of exports. That does not count, well, I'll hit on natural gas here in a minute. A huge amount of energy. If this was 15 years ago, we'd have been net importers of petroleum products and oil. Um, and I think you would see a much different price environment than what you do today. Uh, Result of that, though, is we're drawing down our inventories very quickly. Both commercial and strategic petroleum reserve are each down, round numbers, about 50 million barrels each, so 100 million combined. If you look at the strategic petroleum reserve, we're back to a level in the U.S. that we were at really towards late 2022 when we drew down the SPR following the Russian invasion of Iran, or excuse me, Russian invasion of Ukraine. Excuse me. Um, and we've drawn those inventories back down to that level, really in a matter of several weeks. So it took us 2.5 years to build them back up. So I guess the punchline here is it's going to take a long time to build those inventories back up. The last time the inventories were as low as they are now and in 2022 was all the way back to basically 1983. So the strategic petroleum reserve in the U.S. is quite low, and just globally, we've seen. So we're on a day roughly 100 of the war, and we're losing anywhere between estimates 10 to even up to like 15, but let's call it 12 million barrels per day. We've chewed up globally more than 1 billion barrels of oil out of inventory, and that will take a long time to refill. So just because the war ends, that's not going to be. I think we will see instantaneous relief in oil prices, but that's going to be temporary, and prices will stay elevated for both oil and gas globally, probably for quite some time because there's a lot of inventory to be rebuilt. And it's going to take a while just to get fields back online and get the Persian get shipping traffic moving smoothly again. So uh, I wish I could say that it's going to be a smooth seas ahead, but I think it's going to take a little while to get the energy market back to normal. Same thing on natural gas. We're exporting about 18 billion cubic feet per day. Um, That's up significantly over just 1 year ago. And of course, similar reference, if we were looking 10 years ago, we'd be importing quite a bit. So it's been helpful to balance or at least keep the market less out of balance globally. But, you know, we're exporting as much as we can, at least for the near term until additional expansion projects come on. And if you think back to that earlier slide, our natural gas prices are actually down for the year. So, um, you know, pretty good result there. And then if we think about what this means for the U.S. energy sector, um, I'm sure a number of other Tortoise folks have said this, but longer term, what this means in our view is it highlights the value of U.S. energy supply and that stable and reliable supply. And we do expect additional contracting in the years to come, or in the quarters to come for multiple year periods, as in particular Asia looks to diversify their energy supply. If we want to flip forward, I'm going to shift gears and talk about capital markets. So one thing that's unique in particular for energy recently is capital markets have picked back up quite a bit. If you look at the top set of the top half of the page, those are both energy and AI infrastructure IPOs. So basically what falls into our universe at Tortoise. You can see it's been quite active year to date and, north of $12 billion of activity. That does not include June. So, so far in June, we've seen two additional, what I'll call power infrastructure IPOs, that add another, I believe, $3.5 billion to the total of IPOs for the year. And again, this isn't obviously total IPO market. This is just what, kind of falls into our universe. I included on here because I think this is interesting, the expected price range and then where things actually were offered. So multiple cases where the IPO price ended up coming above the original range, which is a bullish sign, a sign of exuberance anyway, in the IPO market. And then you can see the last price. This is as of 5/31, so doesn't it's not up to date through today, but nonetheless, all these IPOs have performed positively, some quite well. Forgent was one that we were fairly active on, and you can see it was up north of 100%. So pleased with that one. And I would say, probably more to come. Obviously, the big one that everybody's talking about is SpaceX, along with OpenAI and Anthropic. So uh, I was reading an article. I believe Goldman Sachs estimates with those IPOs plus kind of the overall market, sort of mega IPOs, and then what's going on elsewhere, could see $160 billion of IPO activity this year. So I don't know if that's a record. I would assume so. The other space that's been quite active on the secondary markets there, so on the bottom half of the page, not as exciting as IPOs, but nonetheless, a lot of activity in particular for the electric utilities as they look to add generation and build out their transmission and distribution networks to meet growing energy demand, growing electricity demand. A little more muted performance there. That's normal, frankly. Equity secondaries are typically not. I mean, not that they're not well received. They just don't trade particularly great. So, nonetheless, I think we will continue to see a fair bit of activity there as utilities, generally speaking, are not free cash flow positive. And are need equity funding along with debt capital markets to fund it's absolutely massive capital budgets that are leading to fantastic earnings growth. So these are good returns that they're earning on this capex, but nonetheless does require some capital raises. So if we want to move ahead, excuse me, one touch quickly just on how we're positioned. Looking at the various pie charts, energy infrastructure, that's a low turnover strategy, so we haven't had much activity there. Broad energy, we are a little more active in terms of kind of moving around allocations. Just over the last 30 days, haven't had any significant changes there. Within electrification infrastructure, so that's a combination of power, gas pipelines, and electrical services, et cetera. There, we've actually shifted about 10%. If you look back to our slides from last month, about 10%. out of power into energy infrastructure, natural gas infrastructure. And that's really a function of, think back to the performance that I showed you earlier. Energy is actually traded kind of, surprisingly not that great for the quarter, despite, some fairly positive tailwinds going on kind of longer term. So just a relative value shift there. And then on the next slide, I can hit the AI infrastructure and nuclear. Within AI infrastructure, I would just highlight that we've increased our digital infrastructure weight, both through trades as well as just market value has been very strong there. And then we've also increased our data center exposure. Both of those have come out of the energy bucket. And then within nuclear, no meaningful changes there. So uh, I'll leave it there for now and turn it back to you, Jake.
Cool. Thanks, Matt. That's been very, very good stuff. I know this is all very timely topics. Did a great job making it very easy to digest. Um, we do have a couple of questions that have come in so far. I'll kind of go in reverse order based off the topics you discussed. So the first one is, with regards to capital markets, are we expecting more activity to come? What's the team's thoughts on what to expect as we get into the second half of the year?
I would have said about a day ago, absolutely within the AI infrastructure space, but and I'm saying this kind of flippantly. Uh, there's been some pretty significant volatility the last several days. So, and an IPO today, the price that's actually down, which is the first one in I think maybe not. Yeah, I think it's all year kind of in our universe that's down. Um, so, it may pause temporarily. I'd say there's significant interest in kind of AI infrastructure and energy infrastructure. So, uh, if we see a temporary pause, I think that it will be just that, so temporary. Um, I think it will be interesting just to watch how some of these mega IPOs, how the market digests them. Obviously, capital markets are pretty significant, but the SpaceX IPO is at $80 billion, pretty darn big. So um, apparently, it's oversubscribed, but I've never heard of a deal that's not oversubscribed. A little inside baseball there. Um, so anyway, long story short, I'd say yes, we will continue to see IPO activity. We might see just a little bit of a pause here temporarily. Um, the other space I talked about are the secondaries within utilities. I mean, their capital needs aren't going anywhere. If anything, they're moving higher. So we'll probably continue to see active secondary markets within the utility space.
Cool. Very good. One more question. So we have been, quote, very close to a deal to reopen the strait for 3+ months now. If we're still very close to the deal, say 3 months from now, what's your projection for oil? Looking at 150 bucks a barrel?
Yeah, so let me just hit the first part of what you said there. Obviously, we have not made, well, it would seem from, an outside observer that we have not made any progress on reaching a deal, yet we keep getting, we're close to it. I think what's really happening is we're just, really making the problem worse. I'm not sure what else to do, but every day that goes by where we don't have a deal, the longer term, the impact will be longer and longer lasting. What might really cause the market to recognize the shortage that we face? Because frankly, $100 oil is quite reasonable, in my view, given the level of disruption and the amount of barrels that we've lost off the market. And I think what would cause the market to really take notice is actual shortages, like physical shortages. We saw some of that early on as the war broke out. Um, Governments had a coordinated global release of about 500 million barrels. Not quite, but I think that helped kind of keep things functioning. But there's only so much that we can draw out of inventory, and frankly, at some point, we're going to have to refill it. So the longer and longer this goes on, I think there's absolutely a risk we could see $150 oil, if not more. Um, what is interesting, I mean, I say interesting, the back end of the curve is still relatively, I mean, it's moved higher. But if you look at oil prices for 12 months out or 24 months out there, significantly lower than the spot price that everybody refers to. So I think partially we have to see the back end of the curve move higher, and then perhaps producers will respond and increase supply. Um, Absent that or significant demand destruction, which we would see most likely at, you know, you mentioned $150 oil. Obviously, we'd start to see pretty significant demand destruction, I think, at that point. But nonetheless, it's hard to see kind of how this is going to work out exactly.
Gotcha. No, thank you. That was very, very helpful. And yeah, you did a great job today. That takes care of all the questions. So yeah, thanks again for your insights today. Thank you to everyone who took the time to join us. Our next webinar is going to be on July the 9th. If there's any questions that pop up or any follow-up you'd like to discuss, please reach out to your Tortoise representative. You see on the screen there, that's our territory map, which is also on our website. So, again, thank you very much. We appreciate your time and have a good rest of the afternoon.
Thank you.